Good morning, everyone. Welcome to the second in our series of presentations today for the contracting community. We've got a long list of experts I'm talking. We've just had a presentation from Mark Islin on strategic investment for contractors, which went very well. Those unable to attend, the recording will be available in due course. This next instalment looks at IR35 reforms, entrepreneurs relief, and the liquidation of your personal service companies. Especially in light of the IR35 reforms, lots of contractors may be considering what next and what to do, and hopefully we'll go through in some pace today some of the planning that you need to be thinking about around that. Today I'm joined by two of our experts, Tom Wallace, Director of Tax Investigations at WTT Consulting, and Leila Ghazali, our trainee solicitor at WTT Legal, who are going to talk us through the IR35 reforms and entrepreneurs relief. And then in the middle of that, I'll touch on the liquidation and the process for that in a very kind of straightforward way. We'll then take some questions. There are a lot of people on the call, intended to be on the call, so there may be some questions, there may not. As always, we remain available at the end of this or after, any of the three of us to take your questions on a more detailed personal basis and help you plan for the next year and beyond. So without further ado, we'll move on to the presentation. So for those unfamiliar with WTT, we are a group of companies which focus on tax advice, both tax inquiries and tax planning, legal experts and wealth professionals working together to create a cohesive team of advisors. We're pretty clued up, or we'd like to think we're pretty clued up on all things contractor related. So hopefully these sessions will be informative for you. And as I say, there will be recordings of the sessions if you're unable to attend them throughout the day. So IR35 reform. I'm going to pass over to Tom for this initial introductory session. And Tom's going to talk you through the planned reforms that were delayed from earlier this year and it's set to be implemented in April 2021.
Good morning, everyone. As Rhys said, thank you for joining us. I'm going to cover here the IR35 reforms. It's going to be quite a high-level overview. We're not going to go into details of IR35 tests or what makes you inside or outside IR35. If that is something that interests you, I very much suggest that you sign up for our session later on today with Keith Gordon, who is a barrister who's dealt with a lot of IR35 cases and will be giving his insight into some of those case tests and case law that's developed over the years. What I am going to talk about is the reforms and the reforms to IR35. Now, the reforms came into being in 6th of April 2017 if your end client operates in the public sector, and it was due to come in on the 6th of April 2020 if your client was in the private sector and was a medium or large entity. Now, I say due to come in 6th of April 2020. What happened is COVID-19 came along. And one of the government's responses was to postpone the reforms from 2020 to 2021. So the reforms for private sector is now scheduled to take effect for any payments that occur after the 6th of April 2021. I got quite frustrated on LinkedIn when that announcement was made because I saw a lot of people posting IR35 is postponed, IR35 is delayed, IR35 is no more. Completely wrong. IR35 is the same as it has been since the year 2000. Nothing has changed. The reforms simply look at who is responsible for determining the status of whether you, as a contractor, or the contract that you have in place is inside or outside IR35. So none of those tests have changed. Yes, they develop. Yes, the courts develop their views on them, but IR35 in principle has not changed for 20 years now. Do I have control of this, Rhys, or is... Brilliant, great stuff. So we've said the decision for the status determination has moved to the end client if they are a medium or large company. So to define who's a medium and large company, it's just easier to look at who is a small company. So a small company is small for tax purposes if it meets two of the conditions. Annual turnover is not more than 10.2 million. The balance sheet total is not more than 5.1 million, and the number of employees are not more than 50. So if the company meets two or more of those conditions, it's large. It's small. If it meets two or more of those conditions, it's small. If it doesn't, then it's large or medium, and therefore the status determination moves to them. That definition comes from the Companies Act 2006. There are a number of companies who are never small, regardless of whether they meet those tests. Public companies are never small, never classed as small for these purposes. If it's a group of companies that includes public listed companies, it's not small. Authorised insurance companies, banking companies, and e-money issuers are also among those who always will fall within the definition of medium or large for these purposes. And effectively, the reforms mean that if you're determined inside IR35, then the responsibility for deducting the tax and national insurance moves to the fee payer. Now, the fee payer is the last payer in the chain before your personal service company. So if you have an agency, you might even have one or two agencies in the chain, then it's the last agency that has the engagement with the personal service company. Some people have direct engagements with end clients, and it will be the end client who's responsible. Most, however, do go through some form of agency. So they're responsible for making the deductions, and if they get the determination wrong, so let's say that the determination's been made by the end client, they say that you are outside IR35 for tax purposes, and the revenue later come along and say that that is incorrect, then it's the fee payer who has the liability to HMRC for the tax and national insurance that's due. So that's the whole purpose of the reforms, really, to shift that obligation to other parties. I think we could all speculate why HMRC have done that. Clearly, there is a drive here to raise revenue. The Treasury estimate an additional 1.3 billion will be raised by 2023. That was their initial prediction. That may move out to 2024, I guess, but the reality is, with massive holes in the red book at the moment, it's almost inevitable that HMRC will see IR35 reform as a rich, fertile ground for inquiries in the short to medium term to recover some of that lost revenue. So it's very careful. PSCs are clearly being very careful. We've got a session later. If you talking about blanket banning, if that's something that you're interested, please join us. But other than that, I'm not going to say much more than that on that subject. So we've said already the obligation to make the determination falls on the end client. What the end client must do is make what's called a status or give what's called a status determination statement. So effectively, once they've made that decision, they must put that decision in writing, and they must then pass it up the chain to the agency and the PSC to give their decision on whether it's inside or outside IR35. And obviously, the agency has the obligation, or the fee payer has the obligation to operate in line with that status determination. Now, you can make representations to the end client if you don't agree with the determination. So if you think they've misunderstood your working practices, or if you think you've misunderstood some of the terms of the contract, you are able to make a representation. The end client will have 45 days to say whether they agree with your representation or not and change their status determination, or inform you that they're not changing their status determination. And that is all part of a rather informal process. There's no external bodies involved in that. There's no arbitration committees or unions. It really is just asking the end client to reconsider. Now, perhaps a good end client would engage an IR35 specialist to review it, and would perhaps look at get a contract lawyer or someone to make an informed determination. But ultimately, they're under no obligation to do that. The end client doesn't, after 45 days, if they've not made a decision, then the obligation for deducting the tax and national insurance falls back onto the end client. So it's in their interest to give you a decision on that within 45 days. So how do they make the determination? Again, there's nothing prescriptive in legislation that says how they must make that determination. CEST is available. That is the revenues tool. It's essentially a number of questions about the engagement. It's widely criticised. I think in the professional community, it's not unfair to say largely discounted, and because it mainly fails to take obligation of account of the MU obligation, mutuality of obligation, because the revenue hold this view still, despite court decisions, that there will always be a mutuality of obligation in the contract. I think any decent IR35 expert or contract lawyer will tell you that that's simply not true, and indeed the courts have said that that's not correct either. So CEST is widely discounted. There are commercial products out there similar to CEST, which are designed to take account of case law that's been developed, particularly around mutuality of obligation. I'm not here to promote any particular commercial product. I think there still is an element of automation about them, and given most people contracting that we deal with are in the IT industry, I think most will agree that any sort of computer program is only as good as the information you put into it. So our preferred route is to actually have an expert undertake a review of the contract, not only a review of the contract, but also take a review of the working practices to make sure that they line up with the contract, because should the revenue come knocking, it will not simply be enough to say the contract says X, Y, Z. Your working practices will have to match X, Y, Z. So it's a bit of a false economy to just have a contract that pays lip service to what it deems to be enough to move it outside IR35. So an expert review will always take account of all of the factors and make a determination based on those. And of course, depending on that determination, depends how you operate going forward. Most, if they have an inside IR35 determination, well, first let's say if you're outside IR35, then clearly carrying on using your PSC is probably the most efficient and logical answer to the question. If you're inside IR35, though, you have a number of options of how the deductions operate. You can move to what's called an umbrella. An umbrella effectively becomes your deemed employer and deducts tax and national insurance. These are almost everywhere, I think, when you're in contracting. Most umbrellas, though, should offer you roughly the same take home, because they're all deducting pay as you earn. The tax code is there, the tax tables are there. It should all come up, give or take a few pounds based on what the fees are that they're charging. So most umbrellas will give you roughly the same take home. Beware of anything that is offering you significantly above any other umbrella, and particularly if it's offering you 80%, 85%, 90%. and it comes with hallmarks such as HMRC approved and QC approved, and it's offering you weird and wonderful payment options such as investment payments and annuities and loans and all this stuff. If you haven't heard of these type of schemes, you're probably fairly new to contracting, because these type of schemes have been going on for best part of 20 years now. They have been challenged by the revenue. They continue to be challenged by the revenue, and they are what the revenue class as tax avoidance by disguising remuneration into some other payment. We could sit here and say who's right, who's wrong, who holds the liability and who doesn't, but ultimately, if you are getting into these schemes now, you are storing up considerable anxiety and pain and potential tax liabilities going into the future. And many contractors will tell you about that. So please be aware of anything that's offering you artificially high. And they are targeting, they are seeing all of this is coming. I mean, the umbrellas originally started being seen around about 2000, because IR35 was making people worried then. So this was one of the sales pitches of these umbrellas, and the wheel is being reinvented again. They're using IR35 reform to offer these kind of take homes and say that people can still take home the same sort of pay whether they're inside or outside. Just please, I can't emphasize enough, beware. You can continue with your PSC. Clearly that will incur costs such as accounts still being needed to be drawn up, bookkeeping, etc., but effectively the money that the PSC receives after tax and national insurance is a deemed payment, and that can be removed from the company by and large without any further tax consequences. So you still can use your PSC. You just have to decide whether that's a cost efficient way moving forward. The other option, if it's available, is to go permanent. Essentially go on the books of the end client that you're working at. Now, going permanent, while it might bring in slightly lower than what you're bringing in as a contractor, you do have to factor in such things as holiday pay, sick pay, pensions, all of that sort of stuff that makes up the whole employment package. So it's not necessarily for everyone. It doesn't necessarily give everyone the freedom that they wanted when they became contractors, but it is worth considering if you have an inside IR35 determination, and particularly if you see yourself at that client for a period longer than sort of, a year, 2 years. So hopefully that's given you a really broad level overview. I mean, we will have questions at the end. We can answer any.
We can take a few questions now, Tom, in terms of the IR35 focused questions. We have a few and some good ones. The first question for you, is there any possibility for retrospection by HMRC, even if you are now full-time employed or through an umbrella?
Retrospection suggests that bringing in a new rule that wasn't in there in the past. I think I go back to the point that IR35 has been around for 20 years and it's not changed. If you have been classifying yourself as outside IR35 and the reality is that you are inside IR35, you clearly are open to challenge from IRC there. And that's not retrospection, that's under the rules that exist at the moment. So yes, absolutely. What I wouldn't say is that just because you go permanent somewhere where you were a contractor, HMRC will automatically come along and say you were always inside IR35. I think that would be a totally incorrect assumption, and I think it would be ignoring the reality of the fact that a lot of people have had to go permanent because of the reforms. So I don't think that's a risk in itself, but clearly it's a factor in what the revenue will add up as a number of risks, which will include many other risk indicators, but not on its own. I wouldn't say.
Great. In the event HMRC cannot extract deductions from the agency or fee payer, does the liability transfer to the contractor? I mean, go on, go for it, Tom.
No, go on, Rhys. You can cover that one.
I think invariably what we're seeing clearly in the market is that there's lots and lots of insurance products in place which ensure the fee payer and the end client. So our expectation is that where there's an insurance policy in place, that will be invoked, and HMRC will claim from the fee payer, if not the end client, if the necessary compliance measures haven't been met, and as a result, a claim against that insurance policy will be made in one of those examples. We'll continue and talk a little bit more about that on our next presentation at 12:15 on blanket banning and blanket determinations. But ultimately, we would anticipate an insurance policy to be in place. I think from a perspective of straightforward, if there's no insurance policy in place and HMRC issue a Regulation 80 determination on the fee payer or the end client, then that can be transferred to a Regulation 81. Tom, you're probably best suited to talk about that. If you want to go into a little bit more detail there.
I think the reality is here that while we have the kind of legislation in place, what we don't know is how HMRC will operate. Now, the legislation does say it passes down the passes down the chain. So effectively, it goes from the fee payer to the next in the chain, which could be another agency, it could be the end client, and it moves down that way. Now, how they raise that determination, how that potentially could be transferred, and all of that is all TBC. Quite honestly, we don't know, because from a practical point of view, we're not there yet. The legislation would suggest it can't be transferred, but I remain sceptical that HMRC would allow essentially a series of companies to liquidate and let the liability slip away. So at the moment, we anticipate being transferred down the chain, but as Ricky Sunak said when he announced the delays in the reforms, there's a quid pro quo here, and we don't know what else will be added to the legislation before 2021.
Next question. To what extent are you seeing clients and agencies having umbrella companies on their approved supplier list? I think invariably that is very much the case. The preferred supplier list is always umbrellas. And as Tom's mentioned, the umbrellas are perhaps in two camps. One where the umbrella is focused more on tax mitigation strategies and tax avoidance, and the other side, which is focused solely on compliance and ensuring everything is taxed in the correct way. There's a very clear indication as how you can tell the difference between those two things. One is that every penny you received is taxed in some way, and that would be your compliant umbrella. And then where you see amounts on your P60 which don't represent your full earnings not being taxed, then that's the non-compliant route. I think that's as straightforward as you can make that distinction between the two. So it's worthwhile checking your anticipated take home. It's worthwhile checking the projections that the umbrella puts through, and certainly if you're in an umbrella, it's worthwhile checking your P60s. Anything you add?
Yeah, I mean, agencies, let's just say, I think in the past, PSCs invariably did contain umbrellas that were less than straightforward, let's put it that way. I think Criminal Finance Act, the corporate offence of facilitating tax evasion, means that agencies have to secure their chain and their supply chain much better than they have in the past. I would hope that that meant that the due diligence they were doing would keep such umbrellas off the PSL. Let's see where we are in 6 months, 12 months time. I hope they're not on there. I have a fear some will be.
And we've got a final question, which is focused on members' voluntary liquidations and Phoenixism around entrepreneurs relief. We are going to come on to that in the slides, and Leila's going to talk to us on entrepreneurs relief and the anti-avoidance provisions around that. So we will come on to that shortly. I'm going to now take us through members' voluntary liquidation process, which is a fairly straightforward process, but it deserves some analysis in terms of knowing what you're going through and what you're getting yourself into in terms of planning that entire process. As we say here, The IR35 reforms may result in your personal services company being largely redundant. That's the case if you move into an IR35 role and you think there's some element of permanency to that role, or indeed you move to a full-time employment role as a result of the risks surrounding IR35, or indeed if your company that you're working for puts a blanket ban on PSCs and means that you have to work in a direct employment way moving forward. Clearly, in all of those instances, there are still ways that the PSC can be used, and there are planning methods that you can use in that. But ultimately, going forward, if you have some element of permanency to your employment, then the PSC becomes a little bit obsolete. With that in mind, you might be considering closing your limited company down and extracting any funds that remain within the limited company in the most efficient way possible. So liquidation is the term used in the UK for closing down companies, and that method of liquidation will be largely dependent in terms of which way you go, whether the company that you're liquidating is solvent or insolvent. 3 types of liquidation: creditors' voluntary liquidation, members' voluntary liquidation, and compulsory liquidation. Creditors' voluntary liquidation is the process of the directors voluntarily closing down a company that's either insolvent or experiencing financial hardship, and typically that financial hardship is over a sustained period of time. It's usually the last option available for a company, as opposed to a creditor's winding up position, which obviously goes through the court and manifests itself as a compulsory liquidation of the company. Therefore, if your company is solvent in terms of your PSC, meaning that the company can fully pay its liabilities, any interest it's owed, and any contingent liabilities that may become due, then a voluntary strike off or a member's voluntary liquidation is most likely to be the most appropriate way. So it's expected that most PSCs will be in this solvent position, and therefore our focus today is on members' voluntary liquidation and strike off. So starting with voluntary strike off. This is perhaps the easiest and most cost-effective way of closing down your limited company if you have less than £25,000 worth of assets in your company. The criteria, as we've discussed, is that your company is solvent, has ceased trading, and has not changed its name in the last 3 months. The process is very straightforward. It's an application to Companies House to have the company struck off, removed from their register. It is important, though, as we put there, that if you need the company again in the future, it may be more efficient just to keep it dormant for the time being, which again is a very easy process. Just involves a letter to Companies House and to HMRC indicating that the company is dormant, and from that point on you can then reinstate the company as and when it's needed. A dormant company cannot have any money flowing through it, though, and that's quite important. So if you're intending to carry on trading, then you cannot make it dormant, of course. But if you're going into employment for a couple of years and you don't want to get the company removed entirely, you can make your PSC dormant. So if that route isn't acceptable, if you've got more than £25,000 in your PSC and you want to run through a more kind of extensive process, then a members' voluntary liquidation is a process which enables directors and shareholders to put a solvent company into liquidation. As we discussed, it's anticipated that most PSCs are going to be in this solvent position, so it's probably likely if you've got over £25,000 worth of assets in your PSC, then this is the right way for you to liquidate your company. Again, a company is solvent by definition if it has assets sufficient enough to settle all liabilities in full, plus statutory interest within a given period of less than 12 months. Ultimately, the liquidation in this route will allow the release of capital and any remaining assets to be distributed to shareholders in a tax efficient manner. Tax efficiency is in varying degrees, and Leila will discuss on entrepreneurs relief shortly. But ultimately, it's a process that's suitable for companies with assets over £25,000 or indeed more complex structures where a strike-off isn't appropriate. So the tax advantages, as we've discussed. During a member's voluntary liquidation, any proceeds extracted from the company will be treated as capital distributions rather than income. Clearly, those of you who use PSCs will immediately spot the benefit there, that there's an effective tax rate of 20% rather than the dividend or income tax rates outside of an MVL process. So you can immediately see that there's a tax efficient benefit to the distribution being extracted as capital rather than income. Since the funds would be subject to capital gains tax, shareholders may also be able to take advantage of additional capital reliefs, as Leila will go on to talk about with Entrepreneurs Relief, which will be an increase in benefit. So planning for this is going to look at a number of things. You're going to need to assess the status of your company, assess the liquidity of your company, and then decide which of these routes forward you want to take. How long does it take? As we say, the company can be placed into liquidation within a 2 to 3 week period, only if sufficient information is provided promptly. Clearly, there is some delays where there's some investigations or work continuing. The funds can be distributed within days of the board meeting, and it's estimated that it's 10 to 12 months for the company to be fully struck off Companies House and completely dissolved. As we've said just previously, several variables dependent on each case. Some MVLs may be more complex, which may result in a longer time frame and more complexity around the actual liquidation process, but invariably that 10 to 12 months accounts for those delays, so is a reasonable expectation of time. So I'm going to pass on to Leila now, who's going to talk around Entrepreneurs Relief associated with the members' voluntary liquidation process. Leila conducts all of our in-house liquidation processes and Entrepreneurs Relief claims, so really is the expert for you to discuss and ask any questions on moving forward. So over to you, Leila.
Thank you, Rhys. Hello, everybody. So as Rhys said, I'll be discussing basically the taxation points of putting your company into liquidation by way of MVL. As Rhys said, after you assessed your options and your liquidity of the company, and you've made a decision that you want to close down your company, running your company will have administration costs and compliance costs to be met, which might be too much for you at this time, and as well as the sensible planning around the ER rates, you're going to go down the route of MVL. As Rhys mentioned, once you put the company into liquidation, the extraction of the distributions will be treated as a capital distribution, so the tax treatment is at 20% rather than any income tax rates. And also don't forget about your annual allowance, which is £12,300 in the 2021 tax year. But the biggest benefit is if you do qualify for Entrepreneurs Relief, the only rate that you'll be taxed at is 10%. So Entrepreneurs Relief is therefore important for those to consider who want to put their business into liquidation or sell their businesses. Earlier this year, the relief was widely criticised, and basically a lot of individuals thought that the relief was way too generous and actually didn't have the genuine impact it wanted for entrepreneurs to start up a business. So this led to some amendments earlier in the year, and the lifetime limit was reduced from 10 million to 1 million. So it's quite a big reduction, but in all honesty, I think ER was planned to be scrapped or significant changes. So it's kind of still a benefit that's around, and for contractors to make use of if they do close their PSCs. The reason being potentially is because at the time the government really wanted to focus on innovating and growing businesses in the UK. Obviously, due to the impact of COVID-19, this is probably not their main agenda, and there's a lot of uncertainty at the moment. And there has now continued to be more criticism of ER at the moment. ER has been around for quite a long time. Even before Entrepreneurs Relief, there was similar reliefs available, but it was announced in 2008, and it started off with a lifetime limit of 1 million, and then it went to 10 million and back down to 1 million. So of course it restricts the benefit, but it's still something you can make great use of and is one of the best reliefs out there for when you do sell your business. So how do you qualify, and how do you get that benefit of the ER rate? For most contractors, I do see that they will qualify for the conditions. So I'd focus more on the conditions that small, simple PSCs will need to look at when they're looking to see whether they qualify for the entrepreneur's relief. There are a lot of rules around entrepreneur's relief. The legislation is quite extensive, and it can get quite complicated. But as I said, I'll only touch on the ones for contractors who have a PSC. So for contractors, the relief is available for individuals who are a shareholder of a personal company and they make a material disposal. The first condition there is that there must be a material disposal of the company throughout the period of 2 years ending with the date of disposal. This means that the company must be the individual's personal company and is either a trading company or a holding company of a trading group. And the individual must also be an officer or an employee of the company for the past 2 years as well. And that's quite important fact, because I do see PSCs or contractors that are looking to close and they have a partner or a third party that also has 50% of the shares. And a lot of the time I've seen that they do not qualify for the relief because they haven't been an employee or an officer of the company. They were just a shareholder from the beginning. So that's important to remember when you're looking at the relief. So what is a personal service company? Well, it needs to hold at least 5% of the ordinary share capital for a period of 2 years, and the individual needs to control 5% of those voting rights associated with those ordinary shares. So that's just the conditions that need to be met, really, in simple terms, for a PSC. And as I said, usually I've seen most contractors do qualify for these conditions. So how do we make the claim? Rhys, do you want to go on to the next slide? Yeah. So the claim must be made to HMRC in writing, and this is by the first anniversary of the 31st of January following the end of the tax year in which the qualifying disposal takes place. So if the disposal or the distribution was received in the 2021 tax year, then the claim must be made by the 31st of January 2023. And this claim can be made on a tax return or as a standalone claim. But if you do have to complete a tax return or get a notice to complete a tax return, it should be done on the tax return. And another point is just to keep in mind the limit of the 1 million, the lifetime limit of 1 million. So if you do ever make a claim to ER, just keep a note of the amount that you've used up, because it will be reduced. So when making a decision of liquidating your PSC and benefiting from the CGT rates, it's really important to consider the anti-avoidance provisions, because they effectively restrict starting up a new company or a new trade which has similar activities as the one that you currently have for the next 2 years. So if you're only considering to be employed for a short number of time and looking to go back into opening your own business that has a similar activity, then it's probably not the best way for you to go, because these anti-avoidance provisions are in place and HMRC are effectively ensuring that these are met. What the anti-avoidance provisions do is, if you sell your company or and extract the capital at the capital gains tax rate, it just restricts you having to open up a company in the next 3 months or a couple of months. As I said, it's 2 years, but it just therefore restricts the amount of time you can close your company and extract those amounts at the lower tax rate. Of course, this was being widely used before, so HMRC got these restrictions in place. And the rules apply to distributions in winding up for a company made on or after the 6th of April 16, and there are 4 main conditions that need to be satisfied for these provisions to apply. So the effect of the legislation is that the distributions you've received will be treated as income rather than as capital. And I'll briefly go through the conditions with you. So the first condition is quite similar to the ER rules. So where immediately before the start of the winding up, the individual has at least a 5% interest in the company. This is the 5% of the ordinary share capital that will come along with the 5% voting rights. That's the first condition to meet the avoidance provisions, and all these conditions need to be met. Condition B is that the company is close, and condition C is the main condition where there's a lot of examples in case law around, and this is where the individual continues to be directly or indirectly involved in a trade or activity which is the same or similar to that before the company was wound up. So as I said, this is the point where HMRC have a lot of case law and examples around, because there could be a lot of confusion as to what is a similar trade or the same trade or activity, whether selling your company and starting a sole trade would count, which it will do. Any sort of trading, whether a partnership, whether a sole trade, will get caught by the provisions. And condition D is quite an interesting condition, because your HMRC will need to show or prove that the main purpose of the winding up is for avoiding or a reducing the tax liability to income tax. So in cases where there's a genuine commercial reason as to close your company and open up a new kind of trade following that, this means that if this condition applies, then the whole provisions won't apply to you. But of course, there's a lot of arguments around that, and it will be quite difficult to show unless you have substantial evidence that it was not for a reduction of income tax. But in a lot of cases I've seen, this condition is one that has been kind of the saving grace, because of a general commercial reason was seen to be proven. So as I said, if you are looking to close down your company, be wary of the anti-avoidance provisions. You don't want to be in a situation where your income tax applies rather than the capital gains tax applies, and have a liability that you didn't expect for that reason. So I suppose that's the conditions to be met. And if you have any questions, please let us know.
Thanks very much, Leila. That's fantastic. That should have given you all a very quick but brief and oversight of the process that everything's going through at the moment with planning for the PSCs. We do have a question. Now would be the best time to ask those questions if you have any. But of course, Leila and Tom, myself, all available to speak with you post this session if you have any more specific questions that you need some help with. So the first question is, can you benefit from entrepreneurs relief if you close down your company and then emigrate? i.e., do you have to pay the 20% tax up front, then claim the 10% on your next tax return? Leila, do you want to answer that one? Leila, Tom?
Yeah, how it works is just on your tax return, you can report the capital gains tax, and there'll be a box to check to say that it qualifies for entrepreneurs relief. So you can claim for it before you go abroad, or however that would work. If you're a resident, of course, you'll need to report it on your tax return and make the claim then.
Great. Okay. Any other questions before we close this session down? Okay, no further questions. We will. This session is being recorded for those people who wish to listen to the session again. As we say, we'd be delighted to speak with any of you post this session on your more kind of personal, detailed responses. We have a next session which is on blanket determinations and how they can be avoided in terms of their damaging effects on the contracting industry. Then at 1 o'clock we have Keith Gordon discussing IR35 cases, and then at 2:15 today we have cypher risk, life insurance company discussing why life insurance and life planning is essential for contractors from both a tax efficiency and just simple life planning perspective. So we hope for you to join at some of those, but for the time being, thank you very much for joining, and we look forward to speaking with you soon.
Thank you, everyone.
Thank you.